But we begin with the markets, as we always do here on NYSE Live. Joining me now is Tom Hayes. He's the chairman and managing member at Great Hill Capital. Tom, welcome to the show.
Thanks, Ashley. Appreciate it.
So, Tom, we're almost 30 minutes away from the market open. What are you going to be following most closely today during today's session?
Well, I think you had the ADP numbers came in a little bit better than expected at 42,000, so that was kind of positive for the market. People are not seeing the layoffs, the employment. However, that does kind of create some tension for whether the Fed will cut again in December. So I think you've got that. I think you saw yesterday, the big news was with Michael Burry buying 5 million puts on Palantir and 1 million puts on NVIDIA. And I think the shift of thinking framework that happened from that is basically Michael Burry, who predicted the housing crisis and shorted the housing crisis, did what everyone else was kind of thinking, that certain pockets of the market were overvalued and the air needed to come out of the market. I don't think that correction is over, or that pullback rather is over. It's 3% peak to trough. I think we have a little more work to do on that in coming weeks, and that will set the stage for a great opportunity in the year end. Because the more the market comes down, the higher the probability the Fed will actually cut in December. And as we start to get labor numbers, if and when the government opens again, it should set the stage for the Fed to continue the easing cycle.
Do you think the Fed's going to cut in December? What's your prediction?
I do think so. I think we're going to see a little more volatility in equity markets. I think as we get the employment data, it's going to show some pockets of weakness, and that will then set the stage for kind of some year-end strength after a little bit of short-term weakness. And
looking into 2026, what do you see the Fed doing there?
I think they'll be continuing in the direction of easing, but at a slower pace. You know, right now, the positives on the market, even though in short term I see a little choppiness, you have record liquidity, 313 interest rate cuts this year globally. Okay, that's the highest level of cuts since 2010, since the great financial crisis. So it's very hard to get too bearish, which is why we've been looking for a 5-7% pullback and then kind of finish the year strong. Earnings have been very, very good. We're going to grow earnings at 13% next year. This quarter's earnings have been good. 83% beat rate on the bottom line with 64% reporting, 79% on the top line. But we did come into this month with, retail investors buying record call options, the longest streak since 2020, 25 weeks in a row. Bullish sentiment at 44% for AAII sentiment survey. S&P 500 streak above the 50-day moving average, 126, 127 sessions. Last few times that happened, you did get corrections. So, and finally, the most concerning thing is breadth weakening. So we had a spike in 52-week lows. That's not the sign of a healthy market. The highest number of 52-week lows since April, and you know what happened in April. So we're cautiously optimistic. We had built up a little bit of cash in April, not a lot, but off of all margin, a few percentage points of cash, and we're hoping to deploy that in coming weeks as we get a little bit of weakness.
And of course, you mentioned earnings. We are in full swing Q3 earnings season. Yeah. What are your takeaways so far? Any surprises, and what are your expectations?
Yeah, so far, the biggest contributor has been financials, which no one would have expected, and the biggest detractor has been communication services, namely Meta had a big impact on that detraction, Netflix margin contraction. So we're kind of seeing an environment where CapEx is starting to be questioned. And I think what's really interesting about that, Ashley, the percentage of operating cash flow that hyperscalers are spending on CapEx is now up to 60%. Do you know what other industry has CapEx rates that high?
No.
Big oil. So if you recall, historically, these businesses have gotten expanded multiples, high multiples. Why? Because they said they're CapEx light. These are just cash machines. They don't have to make huge investment. Well, now 60% of operating cash flow is huge investment. They still have high multiples. And I think Burry kind of was a wake-up call for the market yesterday, and people saying, we want to see a return on invested capital. And I don't think we're going to start to see that. We will see it, but it's going to take 1.5 to 2.5 years. And in the meantime, all this cash is going out the door. So I think you could see a re-rating in those 7 to 10 stocks that are a little bit aggressively valued. Aside from that, you could literally throw a dart at the board and find a reasonably valued stock. So outside of those 10 stocks, there is a lot of great companies trading at reasonable valuations that you can put money to work.
What other sectors are you looking at?
Well, we have across sectors. GXO Logistics reported today, so that they do logistics services predominantly in Europe. That's one of Brad Jacobs' companies. But we're trying to play the AI play with reasonably valued stocks. So one that we've had for a while is Alibaba. They're the cheapest AI play in the world. Yes, they're up a lot from where we bought it. It's gone from $60 lows to 160 and change. We think they can double again over the next three plus years. Intel, when no one wanted it at $18, $19, all of these designers, NVIDIA, AMD, et cetera, they were at the mercy of Taiwan's semiconductor capacity. They need Intel to succeed. The government has stood behind them. Intel will succeed. They've had a big run. They're going to consolidate the gains for a little bit and then move higher as they get the advanced chips in production. And then Comstock Resources is the cheapest natural gas play. Jerry Jones owns it, Haynesville Shell, that's going to power the data center boom. And then finally is Generac. They do the standby generators. They have a $300 million backlog for data center generators. It's a backdoor way to play the AI boom at a reasonable valuation.
We have about 30 seconds left. How are you advising investors to approach AI?
I think you want to play the beneficiaries over the cost centers. So everyone's now focused in the cost centers, the ones that are investing the massive amounts of money. I think where you want to do it is in the regular unmagnificent 493. There are going to be opportunities that of most companies increasing margins through the implementation of the AI, not the building out of the AI. So look for reasonably valued companies. I think in this chop, value has actually outperformed growth in the third quarter. I know everyone's talking about the hyperscalers, but a lot of that was skewed to August, 700 basis points of outperformance. Stay in the value. You don't have to go all to cash. Just buy reasonably valued stocks. Don't get caught up in the shiny objects that everyone's chasing.
Tom Hayes, managing member at Great Hill Capital. Thank you so much for joining us at the New York Stock Exchange.
Thank you, Ashley.